Hi, so welcome to the stream today and welcome to a brand new week as we continue with a masterclass on the IFRSs for the November 2024 examination. And today we want to get ourselves excited looking at two key accounting standards that we need to know about, still relating to the non-current assets accounting standards. So we are looking at IAS 36, that is impairment of assets, and then certainly IAS 40, investment property. These are still basic accounting standards that relate to non-current asset that we have to know about, and the examiner is going to be getting excited about these standards that we need to know about them. Now, in case you missed any of the last week's sessions, you can watch them on YouTube, but also you can watch them on our mobile application in the free video segment in the mobile application, or on our website at NhyiraPremium.com. You can watch it on the free video page. So either you download the Nhyira Premium mobile application, and on the free video page, all of the lectures that we had last week, they have been broken down into the specific questions, the specific concepts in the free video segment that will help you to be able to really understand the principles and see how the principles apply to various questions so you can put yourself in the position to ultimately pass the examination. So welcome to the stream, and if there are any questions you have, something you want to pick my brain on, you put it in the chat for me, and then I'll be able to provide you with some answers. And then for those of you who are joining me on Zoom, you can also raise your hand. I bring you up, but please make sure that you'll have a good background because we don't want any additional noise coming into the stream as we are streaming on all platforms. But whatever be the case, you can raise your hand. I bring you up if you have a good background, or you put it in the chat for me and I'll be able to provide you with some answers. So let's go straight up into the discussion. Let me pull up my screen quickly so that we can see what we can do here. Let's see. There we go. So we are continuing with our question slide, looking at various things. And first, we want to look at this question you see on your screen. You can take a screenshot of the question or whatever the heck to be able to get access to it. The requirement is pretty simple. We are to calculate the recoverable amount. Now, immediately you hear the word recoverable amount, then quickly you have to be mindful of IAS 16, impairment of assets. IAS 16 must come to town. And so the question we then ask ourselves is, what is the guiding principle on dealing with impairment? So IAS 36, impairment of assets. Now, in a simple language, we say that an asset has suffered an impairment when the carrying amount of the asset is greater than the recoverable amount. So RA here is recoverable amount. So if the carrying amount is greater than the recoverable amount, then we say that the asset has suffered an impairment. But it is important you understand that when we talk about impairment, we are talking about impairment from two angles. The first angle is talking about impairment of a single asset. So maybe a tangible non-current asset suffering an impairment, okay? Or a cash generating unit. Now, if it is just a single tangible non-current asset that we are dealing with, then if there is any impairment, simply we just go to the P&L account and write it off. So that becomes an expenses. We debit profit or loss. Right? Then you credit that property, plant, and equipment or investment property or whatever the heck it is. And that is all. So a single tangible non-current asset can suffer an impairment. And if it does, debit P&L, then we credit that asset because now the asset must be carried at its recoverable amount. The reason why when the carrying amount exceeds the recoverable amount, we say the asset has suffered an impairment is because assets cannot be carried above their recoverable amount. Assets cannot be carried above their recoverable amounts. That is a key principle, and I'm going to be coming back to that in a moment. So a single tangible non-current asset can suffer an impairment, or a cash-generating unit can suffer an impairment. Now, the question we ask ourselves is, what the heck is a cash-generating unit? A cash-generating unit can be defined as simply a group of assets which together can generate economic benefit for the entity. And so a branch of a business can be a cash-generating unit. A department can be a cash-generating unit. A segment of a business can be a cash-generating unit. The business itself can be a cash-generating unit. And so a cash-generating unit can suffer an impairment. A tangible non-current asset, single, can also suffer impairment. Now, this is what you need to understand. If it is a cash-generating unit that is suffering an impairment, yes, we will still write off that impairment in the P&L account by debiting profit or loss. No problem on that. But you cannot just credit one asset because you are talking about group of assets. So you cannot credit just one asset. And so when we are dealing with cash generating units, it means that we need to know how to allocate impairment losses into the cash generating unit or to the cash generating unit. How do we go about it? IAS 36 gives some guidelines on how we go about allocation of impairment for cash generating units. Pretty simple. Number one, we charge the impairment to the separately identified impaired asset. So we are dealing with a group of assets. We are dealing with a cash generating unit that has suffered an impairment. Okay. So if in the question, in the scenario, there are certain assets that have suffered impairment, then we charge them first. So separately identified impaired assets. Number two, if there is goodwill, because we are dealing with a cash generating unit, it could have a goodwill. So if there is goodwill, then we write off goodwill. If the impairment figure, there is still some available. If after writing off the goodwill, there is still some of the impairment available, then we are going to allocate the remainder of the impairment on a pro rata basis using the carrying amount of the assets. Okay, so we allocate any remaining amount to the other assets on a pro rata basis using their carrying amounts. On a pro rata basis using their carrying amounts. But there are a couple of things you must know. Number one, things like cash will not suffer an impairment. Sometimes trade receivable will not suffer impairment. Trade payable doesn't suffer impairment because you don't owe somebody and you're like, oh, I owe you, but your debt with me has suffered an impairment. No, you don't do that, right? So cash doesn't suffer impairment. Yes, time value of money could cause the value or the money to reduce in value, but that's not what we are interested in here. But cash doesn't suffer impairment. Sometimes trade receivables, we have to let it go. Trade payable, nah. Inventory may, depending on the context of the question in that regard. But that is the idea about what we need to understand. Either in the question, it is going to be a single tangible non-current asset, or it will be a cash generating unit. We have to first understand where we are at so that if it is a cash generating unit, you know you have to allocate. So let's come back to the principle and then see what we are going to do. So we say that an asset cannot be carried above its recoverable amount. So anytime the carrying amount of the asset is greater than, or a cash generating unit is greater than the recoverable amount, we say that the asset has suffered an impairment. And so the question we then have to ask ourselves is, all right, what are we looking at? Two things. So we are looking at the carrying amount, as we mentioned here. But that one, you know the deal already from IAS 16. It depending on whatever the heck we are applying. If it is a single asset and if it is we are dealing with IAS 16, then we have less depreciation, so the carrying amount. So that is how much we are carrying the asset at the date of testing for the impairment. So where our headache is going to be will be the issue in respect of the recoverable amount. And so the question we then have to ask ourselves is, how do we calculate recoverable amount? In a simple language, we say that the recoverable amount is the higher of two things. That is, the value in use and then fair value less cost to sell. Fair value less cost to sell. Value in use and fair value less cost to sell. The higher of the two. Okay. Now, what the heck is value in use? Value in use is simply the present value of the future cash flows to be generated from the continuous usage of the asset, which will include any residual value at the end of the economic useful life of the asset. So value in use is the present value of the future cash flows from the usage of the asset. All right? And as I said, this includes any residual value at the end of its economic useful life. That is value in use. So if the asset has a remaining economic useful life of, say, whatever the heck, 10 years, if we are going to use this asset for the remaining of the 10 years, how much are we going to be getting? Then on the 10th year, if it has a scrap value, when we sell it, what are we going to get? So we're going to discount all that into present value. Please note, we discount these future cash flows using the pre-tax cost of capital of the entity. Please be careful of that. So the future cash flows are discounted using the pre-tax cost of capital of the entity. Sometimes it could be called the borrowing rate. It's the same thing. So the pre-tax cost of capital. The examiner is going to be setting a trap for you, where sometimes it can give you pre-tax and post-tax cost of capital. You don't do pimpana nana, C, nana, co, and choose one. No, you're going to use the pre-tax cost of capital. Now, if the cost of capital is just one given in the question and it doesn't say pre-tax or post-tax or whatever the heck, you just use it and go away. But you always have to know we're going to use the pre-tax cost of capital to do the discounting. Now, once we have the value in use, we go to the fair value less cost to sell. The fair value less cost to sell is just like the net realizable value. Okay, so if the asset is sold today or the cash generation unit is disposed of today, how much are we going to get? So it's going to be the selling price less the cost to sell, okay, or the fair value less cost to sell. That is the net realizable value. So we're going to be comparing these two. The higher of the two becomes the recoverable amount. Once we get the recoverable amount, we're going to compare that with the carrying amount at the date of the test of the impairment. And if we realize that, the carrying amount is greater than the recoverable amount, then the asset has suffered an impairment. Please note, if the carrying amount is less than the recoverable amount, there is no impairment, there is no revaluation of assets. The asset will be carried by the entity but at the carrying amount. So you do the work and you see that, your carrying value is whatever the heck, 10,000. You do the value recoverable amount, whatever the heck, 12,000. Then you go and do revaluation surplus. Continue. No. You still carry the asset at its carrying amount, 10,000 and there is no impairment. That is the thing that we need to understand there in that regard. Then the last thing that we have to understand here is this, and that relates to when we are dealing with a cash generating unit. When we are dealing with a cash generating unit, it is important that after the allocation of the impairment among the assets, the carrying amount of the items after the impairment cannot be less than the fair value less cost to sell. That is another golden rule principle. So let me just put that here for us as an NB. So NB, the carrying amount of an asset after impairment cannot be less than the fair value less cost to sell. Very important principle. What the heck does that mean? It means what it says. What the heck do you want again? Now, this is what it means. If we finish charging impairment and we saw that, okay, now the carrying amount of the asset of an item after the impairment, right? After the impairment is whatever, 12,000. Okay? But the fair value less cost to sell of that particular item is 13,200, then you cannot carry the item at the 12,000. It must be carried at the 13,200. So if we are going to carry it at the fair value less cost to sell, what do we do to the 1,300? That 1,300 will be allocated to the other assets in the cash generating unit. That is what we are talking about. So when it comes to impairment, these are the things that we need to understand. Number one is that we compare carrying amount to the recoverable amount. If carrying amount is greater than the recoverable amount, yes, there is an impairment. We write it off in the P&L account. But if the carrying amount is less than the recoverable amount, there is no impairment, there is no revaluation. The asset is going to be carried at its carrying amount. But it is important for us to understand what the heck are we testing impairment for? If it is a single tangible asset in question, then simply we're going to credit it with the impairment. But if it is a cash generating unit, then we would have to allocate that impairment among the assets or the items available, and we follow the allocation principle. Separately identify impaired assets, write off goodwill. If we still have some amounts left, it is allocated in among the remaining assets on a pro rata basis using their carrying amount. But the key takeaway about cash generating unit and allocation of impairment is that after the impairment, the carrying amount of the asset cannot be less than the fair value of the asset. So these are the principles that we need to understand when it comes to IAS 36, impairments of assets. So with this understanding, we go to our question and then see what we can do in respect of this particular question and know or bring what we can say here and see what rule we can apply. Any questions, you put it in the chat for me, and you can also make sure that you share the video as well so that we can reach as many students as possible as we go through these IFRS masterclass. So let's look at this question. Calculate the recoverable amount. So how do I know I have to go remember all these principles? Because of the question the examiner is asking me. Calculate the recoverable amount. So always people ask, how do I know that this is the accounting standard? Immediately you are asking that question, it means you don't know the accounting standards. Because if you know the accounting standards, there are phrases, there are clauses, there are statements, there are concepts embedded in each of the accounting standards. So immediately you start reading the question, it will come. But if you read a question and you don't know which accounting standard to apply, it means you suck in the accounting standard. So we have to go back and look at the accounting standards. That's the thing that you need to understand there. So in the context of my question, I know I am doing impairment. And so all those principles I just spoke to you about must come. So let's see what we have here. An entity has a single manufacturing plant. Oh, good news. It's not a cash generating unit. Has a single manufacturing plant, which has a carrying amount of 749,000 pounds. Good news, we have the carrying amount. Let's continue. A new government elected in the country passes legislation significantly restricting exports of the products produced by the plant. As a result, and for the foreseeable future, the entity's production will be cut by 40%. Cash flow forecasts have been prepared derived from the most recent financial budget or forecast for the next 5 years, approved by management, excluding the effect of general price inflation. Okay. So what the heck am I being given here? We are being given cash flows for the next 5 years. Okay. What is that? If we come back to our principle, that is value in use. So the cash flow we see here is to help us. So you can see future cash flow here. It means we're going to calculate what? Value in use. So we are going to discount the cash flows using the pre-tax cost of capital of the entity. So let's go. They just said an entity. So we could also do entity. No name here. So first, let's get a value in use. As I keep on saying, presentation in accounting is very important so that you don't write haphazardly. You need to make sure you present in an orderly manner so it flows. So we're going to have probably the year here. We can have the cash flows coming up here. Maybe we can have the discount factor here, whatever the heck. Then we can have the present value here. Something like this. We're slashing our currencies here. Discount factor doesn't have currency. So we go. So we see the cash flows coming in. Okay, we are working 3 zeros up. So we want to keep that in. So we have 1 to 5 years. All right. Then let's see the cash flows. 230, 211, 157, 104, 233. 230, 211, 157, 104, 233. Then we go to the next thing. Again, if you pay attention, I keep on telling you something. If you pay attention, I've not finished reading the question, but I read the requirement. Then I know the standard to apply, know the principle. Then when I started reading the question, because I know the standard, I know what to use the information that I'm reading for. So I read, I work. The only way you can become an IFRS wizard, an IFRS goat, is if you understand the IFRS to the level where you read the requirement, you know the principle, and you read and you know what you're supposed to do. There are people who have to read the whole question, then they sit down. Hey, what kind of thing is this? Hey, oh my God. See, by the time you are doing that thing, you have already failed the exam. So that's why I keep on telling you, you need to solidify yourself in the principles. So that immediately you read the phrase, you know, oh, this information, I'll use it for this. This thing, I'll use it to calculate this. So you read, you work. And you have, if you follow my work, you realize that 99.999% of the time, I have never read a full question before starting. Because, again, I want to process the information stage by stage. I don't want to have overload of information. That becomes difficult. But if you're processing it step by step, it's easier. It's easier. Okay. So, we see the cash flows here. Then it says, including disposal proceeds. Because if you remember, we mentioned that the value in use principle, if you remember, we said it here. We said value in use includes what? Any residual value at the end of the economic useful life of the asset. So that's the idea, and that's what we are talking about here. So let's go continue to read. If the plant was sold now, it will realize 550,000 pounds net of selling price. 550,000 pounds net of selling price. So what the heck is that? If I come back to my principle, that is my net realizable value. How much we will get if we sell something now. So the 550 is my net realizable value. I don't need a miracle on that here. It's directly there, so I work with it and go. Let's continue. The entity estimates the pre-tax discount rate specific to the plant to be 15%. After taking into account the effect of general price inflation. That's all I'm interested in, 15%, which is the discount factor at 15%. Okay. Usually, we expect that the examiner will be excited to give you the discount factors so that you can work with them. But if the examiner doesn't, you learned this in KG2, how to calculate discount factor. It is 1 over 1 plus R exponent n. That's how you calculate the present value. So, for instance, if just illustration, we are going to use these figures here, but just illustrative purposes, if we want to just check it, let's do for the year 3, okay? If we are doing for year 3, what's going to happen? We'll have 1 over 1 plus, the R is the rate, which is 15. So 0.15 into bracket exponent 3. So you punch this out, it should give you the answer that we have here. So 1 over fraction, 1 over bracket open, 1.15 bracket close, exponent 3, 0.657, whatever the heck. All right. Now, in the exam hall, if you have to be the one to calculate it, you can do 3 decimal places or even 2 decimal places. Just state it down that, okay, all workings are done to 2 decimal places or 3 decimal places, right? Because you need to state the assumption that you are using down so the examiner doesn't understand, or the examiner gets the information about what exactly you are doing. So sometimes we would have to calculate these ourselves. Other times the examiner is quite generous, and so he would just give it to you for you to work with. So if we have to calculate it, this is our formula. You must know it so that when you get to the exam hall, you don't now sit down, hey, how the heck can I calculate this? Nah, it's already there. You know how to calculate it. But we're going to use these figures here. So give me a sec. Let me pull this here. Okay. So we're going to have 0 point. In this question, we have a lot of figures to be dealing with. 6957, 0.75614, 0.65752, 0.57175, 0.49718. Please, you are not sensible than the examiner, because some of you or some people, they will decide to work to 2 decimal place or 3 decimal place when the answer has given you these figures to work with. If you don't use the figures and you choose to do 2 decimal place, 3 decimal place, there is going to be a variant in your answer, so you are wrong. So if you are given the rate, whatever is given to you, please, you are not sensible than the examiner. With all due respect, use what is there for the work. If the examiner gives you just the rate and you have to do the calculation yourself, then you can decide that I want to work to 2 decimal place or 3 decimal place. Even sometimes in the question, the examiner may tell you to work to a certain decimal place. So be mindful of that. I am saying this because of, again, what goes on behind the scene. Because sometimes people want to cut corners. Oh, look at this plenty figure. If we run it to 0.870, it's the same thing now. So let me do 0.870 or let me do 0.9. No. You didn't set the question. If you become examiner, you can set the question the way you like it. But you have to work with what is given to you in the question. So we punch these out to see the answers we have for us. So 230 times 0.68957. That's around 200,000. 0.00, that's insignificant, so we will ignore it. 211 times 0.75614. That is 160 to the nearest thousand, as we are working with 3 zeros up. 157 times 0.65752. That's 103. Then next, 104 by 0.57175. That's probably 59. You can try to do 60, but we can leave it at 59. 233 times 0.49718. And that is going to give us 115 point. So 116 in that case. So we add the present values up, and that gives us the value in use, which is the total present value. So 200 plus 160 plus 103 plus 59 plus 116. And that is 638,000 pounds. And that's our value in use. Once we have the value in use, we can now compare that with the fair value less cost to sell, which was given in the question as something earlier, 550,000 pounds. What is the principal? The higher of the two. The higher of the two. So the question we ask ourselves is, what is the higher of the two? The value in use. Therefore, the recoverable amount is 638,000, the value in use. So now we have our recoverable amount. Then we compare that to the fair value, the carrying amount given to us in the question, 749. So there's going to be an impairment. So as the impairment loss, 749,000 minus 638,000, and that's going to give us my answer minus 749, and that is 111,000 pounds. So again, let's go back to the context of the question because it's in two folds. It says, calculate the recoverable amount of the plant. That is what we have done. That is why when I finish, I wrote this answer down. If you just do the work, that workings and go away, you have not answered the question. Because the question said, calculate the recoverable amount. So when you finish, you have to tell us, what the heck is the recoverable amount? So therefore, the recoverable amount is 638,000, which is the value in use. Then the second part of the question says, any impairment loss. And so we now compare that recoverable amount to the carrying amounts given, and that gives us 111,000 pounds. That becomes the impairment loss. Certainly, this will be recognized in the P&L account, but we were not asked to represent or extract any financial statement. Again, what you are not asked to do, don't do it. Stay within the ambit of the question. Stay within the context of the question. So that is the answer to the question, and that is what we must understand in respect of accounting for impairment of assets in a single entity. So again, once you read the requirement, boom, IAS 36. Number 2, they said an entity has a single manufacturing plant. So I know I'm not going to be dealing with what? A cash generating unit. The second part, I know I'm going to be dealing with a tangible non-current asset. That's how the principles unfold generally in that regard. And that brings me to the end of this particular question, impairment of assets. Any questions, you put it in the chat for me. Let's see. I think I got some comments. I don't know if I can pull this up. What the heck? Timothy said, good evening, sir. All right. Good evening, Timothy. What else do I have? I'm seeing a chat here on Zoom. Good afternoon. Will the video be posted on the website? It's a public video. It's available on YouTube. You can get access to it on our YouTube page. In that case, okay. Let's look at the next question here. It says requirements. Do the buildings referred to in A to D above meet the definition of investment property? Ooh. So IAS 40 must come to town. And this question is not about accounting for investment property. It is about identifying investment property. Because look at the context of the question. It says, do the buildings referred to in A to D above meet the definition for an investment property? So the question we need to ask ourselves is, what the heck is an investment property? And that is covered in accordance with IAS 40 investment property. Simple. We said that investment property are assets that have 3 issues. Number 1, the entity has bought the asset but holding on it for capital appreciation. Number 2, the entity has bought the asset but they have leased it out on a on an operating lease term. So they have the asset, they are holding on it for capital appreciation, number one, or they have leased out the assets as an operating lease in that regard so that they can get rental income every period. That's the second thing. Or the third thing is the entity is undecided, especially if it is a land on the use of the asset. So that is the identification. That is the criteria. If an asset is held for capital appreciation purposes, is leased out for operating lease, or the entity is undecided, it can't be accounted for in accordance with IAS 40. Now, let me bring down the principle a little bit, although we're not going to be applying it that much in this question. How do we account for investment properties? Number one, the initial cost of an investment property is just like IAS 16. So it is the construction or the acquisition cost plus all other directly attributable costs incurred in bringing the asset to its present use. No miracle on that. On subsequent measurement, by default, investment properties must be carried at fair value. That is the default way of accounting for investment properties. Okay, that's the default way of accounting for investment property. They are carried at fair value so that any fair value gain or loss will be recognized in where? P&L. Any fair value gain or loss is recognized in P&L. That's the default way of accounting for investment properties. But remember the fair value principle in accordance with IFRS 13, right? There must be an active market, or we use the fair value of similar assets involved in similar transactions, or we will use information relating to the asset itself. So if it is impossible or it is not reasonably reliable to use the fair value model for an investment property, then the investment property will be carried at the cost model. What does that mean? It means the investment property will be carried at the historical cost less any accumulated depreciation or impairment losses. Okay? At the historical cost less any depreciation or impairment loss. What does that mean? It means, yes, we can have an investment property and it will be depreciated. So it is not all investment properties that can be carried at the fair value. Some investment properties will be carried at the cost model. And as I said, if the investment property is of a specialized nature, the fair value cannot be reliably measured, then certainly it will be carried at the cost model and it will be depreciated over its economic useful life. That is something you need to understand well when it comes to investment properties. And we are done with the principles of investment property. But before I go to my question, let me say something as it links with IAS 16, what we discussed around last week. There is going to be transfers, okay, from an investment property to PPE. How do you account for it? Or from PPE to an investment property, how do you account for it? So if we are moving from an investment property to PPE, how do we account for it? If we are moving from PPE to an investment property, how do we account for it? Pretty simple. If we are moving from an investment property to a PPE, remember, at the date of the change, we will determine the fair value of the investment property. So in that case, the initial measurement of the now PPE shall be the fair value of the investment property at the date of change, or if you want, transfer. Right? That's it. Because investment properties are carried at fair value, at the date of the change, we determine the fair value. And so the initial measurement of the PPE will now be the fair value of the investment property. Then after that, because now we've moved from IP to PPE, we will start depreciating what? The asset. Okay? So the asset shall be depreciated from that date. That's it. No giddy giddy. But there is a little, spice that we can sprinkle on it if we are moving from PPE to IP. Stay with me. If we are moving from PPE to an investment property, what do? At the date of the transfer, we need to determine the carrying amount of the PPE, right? So we calculate the carrying value of the PPE at the date of the transfer. Okay. Number 2, IP investment properties are carried at their fair value. So we determine the fair value of the asset. At that date. Okay. Why? Because the investment property must be carried at fair value. Okay. So the initial measurement shall be the fair value of the investment property or of the asset at the date of change. Sounds good? But this is where the catch is. If the carrying amount is greater than the fair value, then there is going to be a loss that will be recognized in the P&L account. So where the carrying value is greater than the fair value, there is an impairment loss which is recognized in the profit or loss. Okay. So your carrying value is greater than the fair value, impairment. But if the carrying value is less than the fair value, that's a revaluation gain. We recognize it in OCI. That's the catch. However, where the carrying value is less than the fair value, there is a gain, a revaluation gain, which is recognized in the OCI. And then we'll have revaluation surplus in the statement of financial position as well. All right? We'll have a revaluation surplus in the statement of financial position as well. That's the idea about that. So this is happening at the date of the transfer. Now that is an investment property, it will be carried at fair value, and any fair value gain or loss will be recognized in the P&L account. So after the date of change, we will come to auto factory reset. So that now it will be carried at fair value, so that any fair value gain or loss subsequently will be recognized in the P&L account. That is the idea about how we deal with the transfer. So we can move from IP to PPE or move from PPE to IP in that case. Any questions, you put it in the chat for me in that regard. I'm seeing a comment here. Let's see if I can look at it. Where's my comment slide? Sylvester following. Okay. Ameho David HS said, what is OCI? Other comprehensive income. Really? OCI is other comprehensive income. Okay. So that's all about IAS 40. Very sweet, simple, straight to the point. Now let's come to the question and see what the heck we got for the identification of investment properties. So let's go. A. An entity has a factory that has been shut down. Has been shut down. Okay. Due to chemical contamination, worker unrest, and strike. The entity plans to sell this factory. Okay. Remember the requirement of the question. Do the buildings referred to in A to D above meet the definition of investment property? The first one, no. It doesn't meet the definition of an investment property. This is a non-current asset held for sale and discontinued operation. So it must be accounted for in accordance with IFRS 5 and not IAS 40. That is the answer to that. Very sweet, simple, straight to the point. So again, you see that although you are, the spirit of the question is IAS 40, there's another accounting standard chipping in. So that is why I always tell you, like, the standards are like that. They are together. So you will think, oh, I'm dealing with this standard. Then another standard has to come in to help you answer the question. So the factory, the A, it doesn't meet the definition, but it is a non-current asset held for sale. Because in accordance with IFRS 5, non-current asset held for sale and discontinued operation, we say that an asset or an operation can be defined as a discontinued operation if the sale criteria are met. What does that mean? S means that the management has decided to sell, or if you want, discontinued the operation. All right, that's the first one. To sell or to discontinue the operation. Have they? Yes, they said the entity plans to sell this factory. Okay, number 2, A means that the asset must be available for sale. That is the A, available for sale, which means the entity is no longer using it. The entity is no longer using it. Okay, so they have shut it down and they have put it in a saleable condition. Have they? Yeah. They said has been shut down. So it's not there. Then L means that the entity is looking for a buyer or has located a buyer. Okay, for a buyer, or is already negotiating with a buyer, and that can be seen through probably advertisement or advertisements, depending on the school you attended and the teacher taught you how to pre-pronounce and things. The entity is looking for a buyer, and E means that it is expected that a sale will be completed in less than 12 months. Okay, will be completed within 12 months. Now, if at the end of the year they have still not sold it, IFRS 2 comes in because non-current asset held for sale and discontinued operations are carried at lower of cost and net realizable value, so that any impairment in respect of held for sale or discontinued operations will be recognized in the P&L account. So back to the context of our question, the A is not an investment property. It must be accounted for. The factory must be accounted for using IFRS 15, a non-current held for sale. That's it. Let's look at B. An entity has purchased a building that it intends to lease out under an operating lease. That's no brainer for us, is it? Nope. Because we said capital appreciation, lease out as an operating lease for rental income, undecided for use. Here, the purpose of the acquisition of the asset is for it to be leased out as an operating lease. So yes, this one meets the definition of an investment property and hence must be accounted for in accordance with IAS 40. That's it. Let's look at the third one, C. An entity has acquired a large-scale office building with the intention of enjoying its capital appreciation. Stay with me. With the intention of enjoying its capital appreciation. If we pause there, we will say, oh, capital appreciation, IAS 40, because yeah, that's why they acquired the asset. But, take it easy. Let's continue to read. Rather than holding it empty, the entity has decided to try to recover its running cost by renting the place out for periods which run from 1 week to 1 year. Okay. So it looks like we are coming to the second thing. The intention is capital appreciation. Now they want to rent it out for short term, 1 week, 1 year. So it looks like we are in the second category. So again, if we pause here, you will say, oh, the office building is an investment property because, hey, it doesn't get better than this. Take it easy. Let's continue to read. To make the building attractive to potential customers, the entity has fitted the space out as a small office unit, complete with full-scale communication facilities, and offers reception, cleaning, and a loudspeaker system and secretarial services. The expenditure incurred in fitting out the offices has been a substantial portion of the value of the building. Does this meet the definition of an investment property? The answer is no. Why? Because although they have an intention to hold the asset for it to appreciate in value, they are renting it out between 1 week to 6 weeks. Looking at the significant cost that they have incurred in upgrading the office, full-scale telecommunication, reception, cleaning, loudspeaker system, secretarial services, this is not just something that they are doing. They are real into business. So this office building will be accounted for in accordance with IAS 16, property, plant, and equipment, and not IAS 40, investment property. That's the answer to the question. So again, you don't just take the principle and run with it. You have to understand the context of the question and appreciate what the heck is going on in the question. So they have an intention for capital appreciation. Good. We clap for them. They did good. No P on that. That's okay. That's okay. Yes, they are renting it out 1 week, 1 year. It's okay. But looking at the significant cost that they are incurring, they are into business of renting out the space to make money, and they have incurred significant amount of money into this. And IAS 40 looks at these upgrade that they have made, like they are offering some ancillary services. And such ancillary services is going to be bringing money to the firm. So it cannot be an investment property. It will be property, plant, and equipment. IAS 16. So they won't carry it at fair value. They will carry it at the cost less accumulated depreciation. That's it. Number 4. An entity acquired a site on 30th April 20X4 with the intention of building office blocks to let. Okay. Building office blocks to let. Rentals. After receiving planning permissions, construction started on 1st September 20X4 and was completed at a cost of 10 million on 30th March 20X5, at which point the office building was ready for occupation. Let's continue. Now, even before I continue, I can conclude something here. When was the office building ready for use? 30th March 20X5. So the office building will be recognized on 30th March 20X5 at what? The 10 million pounds. Because it is ready for use. It is ready for use or for occupation. So yes, it will be recognized as an investment property on 30th March 20X5 at the construction cost of what? 10 million pounds. Why? Because the asset was completed on 30th March 20X5 and it was ready for use. We recognize assets when they are ready for their intended use and not when the entity starts using them. Golden principle about date of recognition. Let's continue. The building remained vacant for several months and the entity incurred significant operating losses during this period. We don't care. The significant operating losses they are incurring will be expensed in the P&L account. Okay? The operating losses are recognized in P&L. They cannot include it in the initial cost of the building. They cannot. Because then the last statement says, the first leases were signed in July 20X5 and the building was not fully occupied until this. We don't care. We don't care. So that operating loss they have incurred will be expensed in the P&L account. It cannot be included in the initial cost of the asset. Why? Because at 30th March 20X5, the investment property was ready to be occupied. So although they signed their first contract on 1st July and they have incurred some significant losses, those cannot be included in the initial cost of the investment property. They will be written off in the profit or loss account. These are the things you must understand about identification of investment properties. any questions, you put it in the chat for me. Seeing some questions coming up here. Let's see if I can bring my comment slide. What's it then? I don't know. Evening, I have a question in relation to transfer of IAS. I have a question in relation to transfer of IAS. Are there any requirement that must be met for an entity to transfer the asset? There is no requirement. Like requirements like what? There is no requirement. It's the entity's decision. They are using an asset for day-to-day running, and they are like, hey, we want to now rent it out for under an operating lease. It's their decision. So there's no requirement that needs to be met. All you have to know about is if they have made a decision, how the heck can I account for the asset, which we have also spoken about. So there are no requirements that must be met before it will be done. Okay? And that is coming from what? Aaron or whatever the heck. So that is the idea about that. I don't know, but I think I have a... Okay, so Samuel Ansan, good evening, sir. And I think some of my comments are not... you are doing a great job, sir. Okay, oh, thank you. Some of my comments are not pulling in, so I don't know. All right. So that's it about that. If there are no other questions, I'm going to be wrapping up around here today. And these are some of the principles you must understand when it comes to IAS 36 and IAS 40. So again, especially for the spirit of this question, identification of investment property, yes, you know the principle, but you need to make sure that you understand what is going on in the question in its entirety. If not, you're going to misapply principle. And I say this always as well, that sometimes people read and ignore certain information. Like they just read and they are like, oh, I didn't see this information. I'm like, what the heck and how the heck are you reading in the first place? So you need to make sure that like you are reading the question. Yes, you are reading and interpreting as you go down. Then you need to reach that conclusion. You're like, oh, okay, based on A, B, and C, I'm supposed to apply this accounting standard. And also note that the accounting standards do not work alone. Okay, like Liverpool, you will never walk alone. They sometimes work together, and it is important you understand the principles in that regard. So that's it about that. As I said, in case you missed last week's sessions, you can get them on our website, on the free video session page, or in our mobile application in the free video session page. We've broken those lectures down into the specific questions that we solved, so you can download the mobile application and get access to these content, and you'll be assisted to you'll be able to use them to study on the free video session, either on our website or in the Nhyira Premium mobile application. So that's it about that. God willing, tomorrow we will take something else, another accounting standard or some sets of accounting standards, bring out the principles, solve some questions as well, in that case, as we position ourselves to pass the examination. So that's it about that. And I'll see you tomorrow as we continue with our discussion. 4:30.